So thank you very much, everybody, for being here. So dear delegates, OECD staff and guests, I'm delighted to open this PI seminar organized by the Productivity, Innovation and Entrepreneurship Division in the Science, Technology and Innovation Directorate. My name is Sara Calligaris. I'm a senior economist in this division, in charge of the business dynamics, competition and investment team, and I will chair this seminar. Today, we are honored to welcome Martin Aragoneses, Assistant Professor of Finance at INSEAD. Martin joined INSEAD in 2024 after obtaining a PhD from Harvard Economics Department and Harvard Business School. At INSEAD, Martin teaches MBA Corporate Finance Policies, and it is a faculty affiliate at the Economics of Innovation Lab. Martin research studies the life cycle of the firm in macroeconomics and finance. He combines economic theory with confidential data to understand how startup activity and the dynamism of firms of different age shape the economy. In ongoing work, Martin explores the role of financial markets and institutions in fueling the growth of young firms and keeping mature firms youthful. Today, Martin will be discussing his paper titled Industrial Policy via Venture Capital. In this paper, Martin studies how European governments use venture capital as an industrial policy tool across different stages of the firm life cycle, focusing on the European Investment Funds approach of channeling public money through private VC funds. In order to do so, he combines newly assembled detailed data on IF-backed investment with both empirical evidence and structural models of firm dynamics. Before we begin, I would like to remind everyone a few housekeeping rules. So this event will be conducted in a hybrid format. For those in the room, if you wish to ask a question to the speaker, please use your microphone. For virtual participants, you are welcome to ask questions through the question and answer feature in the Zoom application or in the chat. Should you wish to speak, you may raise your hand and the technical team will assist you in doing so. Before handing the floor to Martin, I'm pleased to invite Beryl, Senior Project Leader at Innovation, Science and Economic Development Canada, to deliver some opening remarks. Beryl, the floor is yours.
Thanks very much, Sarah. Can you hear me okay?
Yeah, perfect.
Perfect. Well, thanks very much, Sarah, for the invitation and to provide a few opening remarks. And good afternoon, everyone, Martin and distinguished colleagues. It is a pleasure to join you for this seminar on industrial policy via venture capital and to help set the stage with a brief overview of Canada's experience with venture capital as a policy instrument since 2010. Canada provides an informative case for a mixed public-private system, one where government has long played an active role in shaping the VC market alongside the private sector, but with outcomes that may differ in important ways from both the United States and Europe. First, on the sources of venture capital. Canada's VC market has historically combined public, private, and hybrid sources. Public involvement has taken several forms, including federal programs administered by the Business Development Bank of Canada, or BDC, BDC Investments, other federal crown corporations such as Export Development Canada and Farm Credit Canada, provincial funds delivered by provincial investment agencies, and participation of private, domestic, and international investors. Before 2010, Labour-sponsored venture capital corporations, or LSVCC, made up a large share of fundraising but generally underperformed, with weak returns and limited innovation impacts. Many operated with policy-driven rather than commercial mandates, which limited risk-taking and fund specialization. Their role declined significantly after reform in the early 2010s. Today, the market is much more balanced, with foreign VC, primarily US investors, playing an increasingly important role. Private independent funds have grown, stimulated in part by BDC's direct investments and federal government-led initiatives, such as Venture Capital Action Plan, VCAP, and subsequent Catalyst initiatives. Through these programs, the federal government co-invests with the private sector in fund of funds and directly in VC funds that support key economic and policy priorities. These programs have aimed to increase fund scale, de-risk early stages and attract additional private sector participation. Second, on sectoral composition. Across the post-2010 period, three sectors has dominated and emerged: innovation and communication technology, ICT, including AI and software, life sciences and biotech, and clean technologies. These patterns mirror global trends. Private and foreign investors disproportionately finance ICT and life sciences firms, sectors with strong R&D intensity and global scale potential. In sectoral performance terms, foreign VC consistently backs the firms with the strongest innovation outcome: higher R&D expenditure, higher wages, and better growth trajectory. For example, the Venture Capital Catalyst Initiative, VC, 2017 Fund of Funds streams has 81% of commitment in ICT funds and 18% in life sciences funds in 2023. Third, on stage of financing. Relative to the US and to a lesser degree and the European Union or EU, Canada has tended to concentrate a larger share of investment in seed and early stages relative to late stage or scale-up rounds. This pattern reflects a market that is still maturing, with later stage capital pools developing more slowly than is more established ecosystem such as United States. BDC and provincial programs have long focused on early stage risk capital, over 60% of their investments, while foreign funds and private independent investors distribute their capital more evenly across stages but still participate significantly early rounds when entering Canadian deals. As deal sizes grow, later stage rounds are more likely to be led or co-led by US investors, with syndicates including both Canadian and US investors accounting for roughly 2/3 of rounds above 50 million Canadian dollars. This imbalance has created persistent challenges. Canadian firms often begin fundraising with domestic investors, but rely increasingly on foreign capital for later stage growth. Compared to the EU, Canada's later stage gap resembles Europeans' pre-2015 landscape, though Canada's early stage intensity is slightly higher. The government of Canada is committed to supporting the growth of a vibrant and sustainable VC ecosystem and to foster access to VC for innovative Canadian companies. Indeed, Budget 2025 announced a new $1 billion Canadian dollars venture and growth capital catalyst initiative to better leverage private investment in the market and support engaging funds and life sciences funds managers. Fourth, on effectiveness and performance. Across multiple studies linking VC types to firm outcomes, several consistent patterns emerges highlighting the strengths of Canadian VC. VC-backed firms outperform on innovation measures, R&D expenditure, patenting, and the formation of global competitive unicorn firms, while also generating more employment and higher wages. Private independent VC funds perform nearly as well, especially when syndicating with foreign investors. BDC-backed firms perform comparably to private VC on many metrics, particularly in R&D and wage levels, though less strongly on profitability, reflecting BDC's mandate to support earlier and riskier firms. Overall, the most effective investment combines three components: participation of a mix of private sector funds, especially foreign or experienced private funds, concentration in high-tech sectors, and strong syndication networks. Finally, turning to today's seminal paper, Industrial Policy via Venture Capital, which highlights EU's renewed use of VC as a policy instrument, particularly through public-private structures, while noting that both the EU and the US allocating more capital to later stage growth rounds than in Canada. Canada's experience offers a complementary perspective, hopefully. While public VC can help build early stage ecosystem, later stage depth, fund scale, and the disciplinary role of private and foreign investors are essential to generating strong innovation outputs. Canada's mixed results suggest that design details, such as mandates, sectoral focus, syndication incentives, and performance discipline matter enormously in shaping the social returns to public VC. I hope this brief overview of Canadian case provides a useful comparator as we turn to Martin's work and broaden the discussion of how industrial policy can strategically leverage VC markets. I look forward to the conversation.
Thank you very much, Beryl. So now, Martin, the floor is yours.
Perfect. So do I see the slides there? Or?
Yeah, you're going to see them.
Gotcha. Okay. Perfect. Well, thank you so much for having me. Thank you for those opening remarks, Barry and Sarah. Thank you so much for inviting me. It's a pleasure to be here at the OECD. This place is beautiful. I'm very happy to be here and interacting with the people here today. So today I want to talk about this paper on industrial policy via venture capital with my co-author, Sara, who's at Wharton. Now, we've been working in this paper this last year, and right now we're revising it in a new version, both empirically and theoretically. So, any comment you have at the end, especially coming from Simone, who is the discussant, would be very, very valuable at this stage. So, there we go. Perfect. Okay, so the key motivation here, as it was earlier anticipated, is that many of the studies of government investment into venture capital activities, which tend to be intermediated by private funds, right, where the government puts money into private funds and then these private funds do their thing, tends to have sort of mixed results, like what was mentioned about Canada. In the empirical literature, especially in finance, these mixed results often come with a negative light. Meaning there's this tendency in the finance literature, mostly empirically, to say, these are activities where the government should just not be involved at all. We actually have a different take. We have a much more optimistic take on the role of governments in venture capital, and we do so from a different perspective. We're not really empiricists; we're applied theorists, and we do so bringing the data, the microdata, to bear in a firm dynamics model where there's going to be financial frictions of two levels. Financial frictions are going to be at the level of the entrepreneur that cannot get access to finance, but there's also going to be financing frictions amongst the venture capital funds that finance those entrepreneurs. So both of these agents are going to be financially constrained. And in our model, the role of government investment, this big G, is going to be to shift the financing constraint of these intermediates, these funds, these VC funds that deploy capital among these financially constrained firms. And how you do that matters enormously. Details of the level of financial development of regions, or the level of tangibility of sectors, or even where you deploy the capital across the different stages of the life cycle of the firm, will matter enormously for what the effects of these type of investments are on the aggregate economy. And so, in our view, the reason the empirical literature tends to be either mixed or negative is because we haven't really dealt with these differences, which the model does head on. And the main application is going to be in Europe. Why Europe? Well, because despite all the savings and human capital that we have in Europe, there's still this sort of big and growing productivity gap relative to the US. And in the model, we're going to have a measure of aggregate productivity that we can study, how it evolves as a function of government investment into venture capital. We're going to focus for this version of the paper on the EIF, the institution in which Simone works at, because we think it's one of the most efficient and most serious institution that does this sort of investment. But this is something that happens pretty much in every single country across Europe. In France, there's BPI. In Spain, there's the ICO. There's institutions like this all over the world. And in principle, our model and our way to aggregate data through this model could be applied across all these other contexts. But in particular, this type of way of thinking is important when you think about the fact that many of the countries that are using these institutions to invest in venture capital with public money are also facing fiscal constraints. So thinking about how to better optimally allocate this funding across these VC funds in a way that's sort of like fiscally appropriate, it's an important thing. It's an outcome that we're going towards in the model. Right? So the basic roadmap is going to be to look at data on the investments by the European Investment Fund and linking that to microdata on firms. We're going to document the puzzle that is something that is, is been sort of thought about before in the empirical literature, which is that, even though most of the impacts of venture capital activities deployed by the government tend to be at the early stages, that's where you see, most of the big sort of elasticities. That's not where the money tends to go. The money tends to go towards later stages, right? So the allocation seems to be biased away from where, in at least in the data and later in the model, where it's most impactful. And this is a question of why, right? Well, the academic finance literature looks at this and says, well, this is just the government being wasteful. What we're going to do is we're going to write down a model where actually these things will make sense. It will make sense to bias, financing under certain condition towards later stages, and that's actually rationalized in our model. But before we get there, we also innovate on the empirical dimension, presenting a new shift share design that shows that actually one of the big implications of the government investing in venture is not actually the money. It's actually coming from these co-investment spillovers that bring in private capital along with the government, right? That bring in, things like pension funds and other what we call limited partners along with the government. And that's what unleashes, when the government gets there. So we think that this is like the direction where the paper is going to go theoretically, and I'll show you a little bit if I have time at the end, if not in the Q&A, how we're thinking about, putting it in the model. But we think that this sort of crowding in of private financiers at the aggregate level, meaning at the level of these intermediaries, is an important role of the government in of itself. We're going to build a macro model that's structural in the sense that we can calibrate it to for microdata in Europe, which we do, where there's going to be this financial frictions at the entrepreneur level, but also at the VC fund level. And we're going to use this to run counterfactuals. We're going to have a very naive counterfactual where we treat Europe as a whole, as the unit of analysis, and we're going to see that actually, well, in that setup, expanding this type of government investment into, venture capital intermediated by these private funds, seems like a bad idea in the sense that it could be potentially cheaper to reallocate it in a more efficient way, right? In particular, given the fact that the allocation seems to be biased towards the later stages, and that Europe as a whole is actually pretty financially developed, it could actually make more sense to keep the budget constant and move the money towards early stage VC. Now, when we go a little bit into more detail, and we see that actually, probably all these different countries and all these different sectors where the government deploys venture capital financing seem to actually be very different along the level of financing frictions. Some countries are going to be much more underdeveloped in terms of their financial markets, and some sectors that they target, as was mentioned, IT, biotech, and very R&D intensive sectors, are going to be ones where, it's almost impossible to get banks to lend you money, even once you have a good idea, later on. So it's going to be precisely in those places where devoting money towards later stage VC as a government investor makes a ton of sense. That's actually what increases aggregate productivity. So we're going to come up with like a model-based way to describe where the money should be allocated in a way that should resemble sort of like a fiscal rule. The goal for the next year for Sara and I is to sort of provide a fiscal rule of sorts that would give government officials like the ones at the EIF a rule to how much money to put into venture in early versus late stages, depending on the country or sector characteristics in terms of how easy it is to finance companies there. So let me first start with the data. So in the data, what we do is something relatively standard, which is we go to the portfolio of investments by the European Investment Fund and we track down where the money has been going, right? We track down, for example, that in 1997 they deployed $2 million into this particular venture capital fund in Belgium, and then we go trace out what companies did this fund invest on. Venture capital funds typically, have around 7 to 10 years to deploy this capital, and then we see what happens to the firms. We can also see where the money comes from. In particular, this fund got money from the EIF, but it could also come from, pension funds, wealthy people that invest money into this private venture capitalists. And we're going to document a series of facts that speak about both the magnitude and the allocation of this EIF money, as well as the elasticities of this EIF money, both at the firm level and at a more aggregate level. The first set of results that we have concerns, this very striking graph. So in blue, you have the level of venture capital activity on average, right? The amount of money raised by firms in early versus late stages between the US and Europe, right? So you see this very big gap that people talk about a lot between the two different blue colors. But what you also see when you look at the part of the venture capital market in Europe that is somehow touched by the EIF, you see this sort of pink line where you see levels of venture capital activity at both stages of development that resemble much more what you see in the US. So this is a first hint that part of what the EIF might be driving is increasing the volume of financing that firms get across all stages. The second picture turns out to be the case that this has actually only been happening in their venture capital investments. When we look at private equity, which is the light blue line here, this increase in the volume of financing per firm that you see for the EIF-linked venture capital investments is not something you have seen in their private equity investments. When they give money to private equity firms, it's not the case that these firms end up getting more volume of money than they will be getting from a purely privately financed fund. But this is something that only has been happening in VC, which is why we focus on that. So this increasing the volume per firm on average that you get is the key mechanism we want to study. You see this even when you go deeper into the micro data. You see that it's not necessarily the case that firms of different sizes get different allocations of the funding. It turns out to be just like an increase in the volume per firm. It's not that they're messing up with we're gonna disproportionately give more to firms with certain characteristics. It seems to be them taking a system that's working in of itself, like it's a private market, this venture capital industry, right, that operates in selecting companies and monitoring them and investing in them and helping them grow. And what the action of the EIF seems to be is simply taking this sort of private machine and scaling it up in volume. Otherwise, we would have seen a shift in the slope, for example, if they were affecting the way that VCs pick companies, for example. We would have seen a change in the slope. We don't see that. It's a simple change in the level. That's something that we bring to bear. And in the model, that's going to show up as a sort of relaxation of an aggregate financing constraint. That's sort of the key innovation that we bring to bear. The other thing you see very interestingly is yeah.
It could just be that they invest in different sectors that are more capital intensive.
This is all happening, within sectors. So this is not being driven by the sector allocation. We're getting into the sector allocation in the new part of the paper. This is sort of happening within sector. Also, something that's happening within sector is the allocation being biased actually towards older firms relative to venture capital funds that do not get money from the EIF. Maybe they only get money from private individuals, wealthy families, or pension funds. Relative to those, you get the blue bars, which is the part of the venture market that the EIF touches tends to devote more money towards later stages. And we think that this is intentional. We think that this is something that is this sort of pervasive, focus on scale-ups, right? So this you have heard of. It's something that I think is an intentional policy target. The sort of finance literature tends to think of this as a bad thing. In our model, this is going to emerge as something that actually has a rationale. It is controversial in the finance literature because when you look at micro-level regressions, this sort of differences, what you see systematically is that $1 or €1 of venture capital funding that goes towards a young firm tends to be more effective at promoting growth than €1 that goes into an old firm. If you just had this sort of diff and diffs, this micro diff and this, you would be well, it would make more sense to actually put more money into early stages rather than putting it into the late. And I think that's sort of the thinking that we want to challenge a bit with the structural model. The other thing you see in the data is, and this doesn't happen for non-EIF government institutions that invest in venture, but for the EIF, it turns out that they tend to actually, the firms that they invest in, they tend to actually outperform to some extent, purely privately financed firms. So there's something very very different about the companies where the EIF deploys money towards. And we think that this is related to this increase in the volume of financing that they bring into these companies. One way to see that is in a strategy that we have developed. We have developed this new instrument. This is a shift share instrument that really speaks to this disproportionate increase in the volume of investment that goes into venture as a consequence of the government going in. So what's happening here in this plot is the amount of money invested by the EIF since pretty much its inception, right? And what you see is that there was a pretty constant amount invested before 2010, every single year. This is the flow. But after 2010, there was this massive increase. We're going to exploit that massive increase that happened after 2010 in a shift share design. We're going to treat the pre-2010 period as the sort of pre-period where we can calculate the shares of EIF funding that were going maybe towards different countries, different sectors, and we treat those shares as fixed. And what we're going to shift is the aggregate amount of funding channeled by the EIF into the system. To look at what is the effect they have on the venture capital ecosystem. And in particular, we're going to focus on the investment into the venture capital ecosystem coming from other investors. I think of the other LPs that operate here. Think of pension funds, think of wealthy individuals. What turns out to happen, and this is not something that is found by other people that study this in the academic finance literature, is that when the EIF puts money, when you look at this sort of like predicted EIF investment that is purely scaling up their pre-build-out allocation, you see this very big co-investment spillovers. Meaning, what happens when the EIF puts money is that they bring in a lot of private investment from other institutions like pension funds, like wealthy individuals along with them. That's something that's been happening way more strongly in venture than in private equity, and it's something that is even persisted over time as the EIF scaled up. And so this is one thing that tells you that maybe actually part of this increase in the volume of venture funding that comes from the EIF investing is not necessarily just the amount of government spending that they bring in, but an amplified amount, a very big amplified amount that's coming from these co-investments of these aggregate investors that bring in money with the EIF. Right? So this opening up of pension funds and rich individuals that come in after the EIF invest in a venture capital fund is a very big part of the question. This is something we're thinking about bringing into the model. Let me now discuss the model, and we talk about the counterfactuals. So the model is going to incorporate heterogeneous entrepreneurs and venture capital funds. They're all going to be financially constrained. And these changes in government spending that go into venture capital are going to be lifting not just the micro level financing friction of entrepreneurs, but most importantly, they're going to be lifting the aggregate level financing frictions that venture capitalists face, both perhaps directly because of the amount of money they give to these venture capital funds, and indirectly because of the fact that they bring in more private financiers that invest into venture. And as a consequence, there's going to be a theoretical link between this amount of money invested and how it is deployed across venture funds that may specialize in their little sector, in their little country, or perhaps in just a particular stage. Some venture capital funds only do early stages. Some only do scale-ups, right? So depending on where you put the money, you may have an effect or another in one object that, per the Draghi reports, we care about, which is aggregate productivity. So our model tells you that this allocation of funding as well as the volume will impact aggregate productivity in a way that we can measure. So the model, I don't want to bore you through the details, but it's going to be the sort of heterogeneous firm model where entrepreneurs, and you can see that in the last line of the three above here, are going to have this financing constraint. So this K, less than or equal to lambda A, is going to be this financing friction. If I'm an entrepreneur and I need to go and grow my firm, unless I have a lot of wealth, I'm going to be screwed. Right? Because I have to go borrow, and banks are going to be looking at the level of wealth I have to be able to give me money to rent capital. Right? Now, this is going to tell you that in countries or sectors where maybe lambda, this degree of financing frictions is very low, things may be different from countries or sectors where lambda is very high. And that's something we can bring into the model. But crucially, what's going on is that these entrepreneurs have different abilities. That they have this power law distribution of your ability, this productivity Z, and they're going to try to overcome this financing frictions to be able to grow. Who is giving them money? Well, they have these venture capitalists in the model. These VCs are going to target firms at different stages of the life cycle, right? So some of these firms have just entered and they're relatively young, but some of them are pretty mature. And because it's for dynamics, they might be close to sort of their optimal size. And most importantly, what happens here is that you have a bit of a Calvo ferry, this fee, where at some point you might get financed by this venture capitalist that may have its own targets of the sector or the stage of the life cycle in which you're at. And if you do get touched by this Calvo ferry, you're going to get an extra bit of financing that adds to your assets. So you're going to get this F inside of your assets, or you're going to get this amount of financing, and as a consequence, because this is an equity financing, you're going to have to give up some of your profits. So you're going to have to give up some of your profits. It acts a little bit like a corporate income tax. And we're going to bring into the model one key equation, right? This is sort of like a relatively standard model for an entrepreneur, but we're going to bring in one key equation. This is our key innovation. Where do these Fs come from? Where did this amount of money come from? Well, when you have a venture capital fund, this is the financing constraint that I was referring to, or the venture capital fund. The venture capital fund has to spend some money, right? It has to give all these Fs across these different firms. It has to find them, it has to match with them, and it has to give them money, right? That's the this side over here on the left. But on the right, this venture capital fund also has to raise money. It has to raise money from private investors. So think of this I as coming from pension funds, wealthy individuals. And when the government invests into venture, they give funds this big G. Okay? So it's a relaxation of a financing constraint that is not really at the micro level, at the entrepreneur level, but it's at a more aggregate level. It's at the level of the financing intermediary. Now, in the current setup of the model, we have a sort of relatively naive way to do this, where we just give money to these funds, and then we have a fixed elasticity of private investment into venture that just scales it up with the size of the government. We have a new version of the model where we endogenize this investment by the pension funds, depending on how the government affects, for example, the level of governance frictions in the environment. But that's something that we can discuss at the end if you want. But this is sort of the key innovation. Why that's nice is because in the model it generates this feature that we have in the data, which is it's not really changing the slope of financings, for example, by size, but it's simply a change in the level. When the government deploys this big G, this government investment into venture capital, because it's happening at the level of the intermediary and not directly at the level of the firm, it's simply an increase in the level of investment on average across firm, which is exactly what we see in the data. I showed you that at the beginning. This could change, for example, if we had things like, for example, the EIC in Europe that goes out and try to find firm and do something more direct, the slope might change. But at least in this particular scenario, when G increases, you have an increase on investment per firm like that. And now what we do in the papers, we study what happens to the economy when you have these increases in G in the paper. So we're going to calibrate the model to match firm life cycle dynamics in Europe. We want to make sure that just as much as in Europe, we have this concentration of economic activity on older firms and so on. So all that is matched, as well as the allocation of the EIF across funds of different stages. That the model is consistent with all that before we do counterfactuals. Yes.
J is not depending on time. Sorry. J is not depending on time, right? So you're assuming that the distribution of the government input is fixed through time. According to data, how accurate is that? I mean,
yeah. So that's something we dealt with in the Bartek. In the earlier period, pre-2010, when I showed you that like the amount of money was pretty stable, so were the elasticity, so were the SJs in the data. So that's why we fixed them in the Bartek. But after 2010, you not only see an increase in the level, but you see a reallocation. For example, they seem to have been moving away from, things like R&D, intensive technologies towards, say, more sort of like IT or computer technologies, right? But for the purpose of the first exercise, we're going to fix the S. In the second exercise, we're going to change the S's. And you'll see what happens. So the first counterfactual says that, look, if you compare what happens when you just keep the current allocation, that's actually pretty biased towards later stage VC, and you increase the amount of money of the current allocation, you're going to get the first pink bar on the left. So you do get an increase in aggregate productivity. Of course, you're dumping more money into entrepreneurs that are financially constrained. They're going to be very happy. Productivity is going to increase. Now, the second set of results say, what if we kept the amount of money constant? We didn't spend a whole dime more, and we just simply reallocated it to invest more, say, in the risk in these early stage ventures that were referred to in the initial discussion, right? Well, that's the blue line in the second set of graphs, and it tells you, look, the increase in aggregate productivity is actually pretty close, even though you're keeping the budget constant. So this tells you that at least as a whole, in terms of Europe, if we thought that this was the way that Europe looked like, perhaps sort of reallocating money away from some of these funds that do more sort of later stage or scale up VC towards early stage funds could actually deliver, pretty similar increases in productivity, but a much lower fiscal cost. So that's sort of like a first, perhaps very naive exercise. Now, in the second exercise, which I think is much more realistic, and we're expanding it right now, is, okay, so why would you want to do this scale up later stage VC bias that we do see governments that invest in VC follow? And the answer turns out to be because of the level of financing frictions. It was almost obvious after, and I just want to explain that to you. So the lambdas, remember, like where the level of financing frictions at the level of the entrepreneur, the micro level, right? So the lower the lambda, the less you're going to be able to, borrow for a given level of assets, right? So obviously, when you have low lambdas, you have a very severe financial friction in countries, where the banks just don't give any money, or in sectors that are maybe, very intangible intensive. But you're going to have a decrease in aggregate productivity, right? The level of productivity of TFP is just going to be very, very low, right? But it's going to turn out to be that this result that you actually want to move money only towards early stages, which in this case, it will be moving all the way to the right. It's only optimal if the level of financing frictions is actually pretty mild. When you have more realistic, high levels of financial frictions, which is the case in many of the countries where the EIF puts money on, and is also the case in many of the sectors that they target. They target, things like, biotech, IT, very R&D intensive sectors. In those sectors, those are the ones with a relatively low lambda. Those are precisely the sectors where actually, you can't just put money in the early stages. You have to put some money in the later stages as well. So this tells you that depending on the level of financing frictions in the sector and the country, you may want to vary the optimal allocation that you target across these different funds that specialize in the little life cycle stage of the firm. Whenever you have a very, financially, either immature or, a sector that just is very intangible intensive, that's precisely the sector where you maybe, if you want to invest in those funds, you shouldn't just put it in the early stages. You should actually, allocate money towards later stages. So we think that, and we're expanding this in the analytical version of the model that we're developing right now. This will give the institutions like the EIF or BPI and others, a guide or a fiscal rule of, if you want to invest money in venture capital for the sets of sectors that exist perhaps in your country, right? Depending on, and we have ways to perhaps measure that, the level of financial frictions or how difficult it is for firms to raise money in those particular sectors, you may want to, vary the shares that you put into early versus later stage funds. So this is what we're highlighting. It probably turns out to be the case that in very, financially developed economies, like for example, the US, it doesn't make any sense for the government to be dumping money into later stages. But it is precisely in those places, in very financially developed countries, where actually maybe putting money into early stages makes a ton of sense. Makes a ton of sense. And this is something that was referenced at in the beginning of the discussion in Canada. This is something I want to bring to bear. So, maybe it makes sense in the US to actually have the government sort of intervene in the entry margin, which actually has been, not happening that much, right? We've seen a massive decline in the startup rate. It's not like, startup rates are pretty high, right? So, yes, go ahead.
In that case, for instance, in the United States, if you want to invest in the early stages, how do you perform once those companies becomes later stages? How do you keep going back? Because I mean, from what I understand, now first step, invest in early stages, right? Now these companies evolve in time, move to later stages.
Yeah.
Then the government should move the money back again to the early stages.
No. So I think so if you want to think about like the pecking order here, when the EIF puts money into, or these type of institutions put money into venture, if they're going into a country that doesn't have a developed venture ecosystem, it makes a lot of sense. It rationalizes what you want to invest in scale-ups first, especially while the system develops. And as it becomes much more mature and much more less financially constrained, and there's more money to go around for these later stages, then is when you want to like maybe shift gears towards early stages. You see, and that's pretty different from what governments actually do. You see, especially in Europe. So I think this is it tells you that this is an important factor. I don't think I have much time, but because I want to leave a discussion with everybody after. But I just want to mention that we are going to come up with a new version of the model soon. So feel free to read the paper, like when we release it. But it will have a simplified version of the model that doesn't necessarily need to be solved in the computer, where we're going to provide a bunch of sufficient statistics that will tell you, in particular, how the different allocation of venture capital investment by the government would interact with this sort of like level of financing frictions at the sector or the region to impact aggregate productivity. Right? So we're hoping to provide sort of like a guide or like a fiscal rule for institutions like the EIF, but also BPI and ECO and others on how to conduct this sort of industrial policy via venture capital in a way that is consistent both with the micro data, but also with a sort of like micro to macro approach. Just to give you a flavor of that very quickly, I just want to say that there are other ways, and this is something we're modeling, of getting the government to influence the venture capital ecosystem. One of them is to just give money to firms to get finance, and the other one is to affect these sort of governance wedges. So things that, for example, venture capitalists care about is like whether if I get an investor that puts money with me, and I'm a private pension fund, am I going to get returns? Am I going to get my money back? And I think part of what the EIF is doing is not necessarily just giving money, but it's providing this sort of like, ease of governance frictions. And in particular, when we look at the results in the Bartek in the data in the shift share, we see that a big chunk of the effects are not necessarily coming from the funds where the EIF sort of puts money on, but actually are coming from the other funds in the sectors and the regions where the EIF money, flows in. So it's sort of like this indirect spillover that may be coming from the improvements in governance frictions. And the certification effects, I think, are really, really big. But they're isomorphic to some extent of just dumping money in. And what we're doing in the model is sort of providing a way to decompose aggregate productivity as a function of these interventions in a way that would hopefully provide a fiscal rule for these types of institutions. So, depending on maybe the level of financing frictions, which you can maybe read off how big companies are that get financed, how much financing they get, and so on. We might be able to tell you, hey, look, maybe these sectors and these countries are really big targets for you. This is where you should be putting the money. To be able to tell that, you need to use things like returns and so on, which we're trying to get a handle on, because we think that precisely in places where there's a lot of need for this type of financing, the minute that the EIF comes in, returns are going to go up, and that's why the private investment follows. So we're thinking about adding that in the model as an enrichment. Okay, so I want to conclude here so that we have time for the discussion by saying we have built a a theory of, or we started to build a theory on, a very, 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 popular thing that somehow was ignored by the theoretical literature, which is governments actually invest in venture capital a lot. And they do so intermediated by these private agencies, private venture capital funds. Now, this brings to bear the fact that, if we think about what are the effects of the government, this type of government investment on aggregate productivity, which goes back to this whole discussion we'll be having after the Draghi report, we need to think about these financing frictions that get lifted. What we bring to the table is the fact that it is not only a micro level financing friction at the level of the entrepreneur, but it's also intermediate level financing friction that's more aggregated. It's at the level of the investor, at the level of the VC, and it takes into account, how easy it is for them to raise money. Now, this is a new sort of, we're shifting the light towards that problem. We think that that's the main contribution, but it really, in principle, our way of thinking about this should be portable to settings that are not necessarily just, of the EIF, but we should think about other places in Europe where these things are important, or even around the world. And in particular, one of the key lessons that we show is that actually the level of financing frictions at the micro level in the country, in the sector, is very, very, very important to determine how you should conduct this, this government policy. The lessons on where you should put your money depend crucially on whether you're targeting a very underdeveloped financial economy or you're targeting a very, intangible intensive sector. And that should be taken into account when choosing, for example, at what stage of venture capital you should deploy this government investment. We have a bunch of, ideas and sort of an agenda of sort of macro finance and development IO, mixed to think about industrial policy. And hopefully you follow along and, you read the new version of the paper when it comes out. Thank you so much. I look forward to the discussion and the questions.
Thank you very much, Martin. Very, very interesting. And before opening the floor to questions, and I know that we have already a couple of questions online, we will read later. I would like to give the floor to our lead discussant, who will provide his reaction to the paper. I want to invite Simone Signore, Senior Research Officer at the European Investment Fund, to discuss the paper.
Thank you very much, Sara. Can you all hear me?
Yeah, we can hear you well.
Fantastic. It is truly an honor and a pleasure, of course, to be speaking and discussing with such a distinguished audience, and in particular, having the pleasure to touch base again with Martin, who I've had the pleasure to meet also in Luxembourg some months ago. In the scope of today's workshop, I'm going to provide a light, let's say, review and discussion of the paper, which of course I enjoyed a lot, and it was extremely interesting to try and dissect. Of course, as a premise, I'm not applied empiricist, nor a theorist, so I've tried with my perhaps more institutional practitioners-oriented eye to try and understand more the parameter of the approach and to try and see if they match what we see also on our side, on the institutional side. With this said, let me dive into the brief review of the paper. I think Martin's premise was that the paper quite nobly tries to address a long-standing theoretical question when it comes to government intervention in general, entrepreneurial finance. I think behind the lens of my own, let's say, team, it's difficult to sort of frame this paper without looking at the Draghi report, because the Draghi report not only offers the Commission's independent assessment on how to restore the EU's long-term competitiveness, it specifically mentions that the three levers that the EU institutions should address are boosting productivity growth, and by doing so, the EU must address the investment gap in breakthrough innovation in particular. And in fact, the report claims that a large EU public investment push can actually catalyze investment to fill the gaps. And if done correctly, it will not be detrimental to the EU's budget. So precisely because of the expansion in productivity. So we have the three ingredients that appear, of course, also in Martin and Sagar's model to let's say, determine whether this type of intervention is effective at restoring and, in fact, increasing aggregate TFP. So obviously, as you saw, the research question is primarily, can public VC drive the EU investment push and help Europe close the innovation gap needed to raise long-run TFP? The answer is a resounding yes. But crucially, its effectiveness depends on how it is allocated and the economic context that it addresses. In the work, the authors conclude that yes, such an industrial policy would be effective, but indeed, under market frictions, the authors observe that a policy skewed almost exclusively to support early stage investments would actually be superior to a more balanced or even skewed policy towards later stage in terms of raising specifically long-run TFP. And so against this backdrop, the authors conclude that there is the current public policy allocation as implemented, for instance, by the EIF, does not exactly match what the theoretical model considers optimal. We've actually heard a lot of reasons why, and unfortunately for me, as I thought some of my points were going to be a little bit quite bright, Martin has anticipated them all. So I will still try to kind of give a summary overview. Before I do that, let me touch quickly upon the data and methods. There has been an impressive amount of data work on this, not only matching and mapping the, digitizing the EIF annual reports, but matching this information with the long-standing commercial databases, PitchBook and Orbis, and of course also the usual public sources, Eurostat, CompNet, etc., etc. There is of course a lot of benchmarking on this data, which proves that the analysis and the data that it stands on is quite robust. In terms of the methods, as discussed by Martin, there is an extension of an equilibrium firm dynamics model of venture finance, where they have included, let's say, an agent such as the VC funds, but this is based on highly influential and highly cited papers that have been published in the last decade and for the last decade or so. My main and primary remark comes with the way the lambda parameter drives the paper's policy conclusions. As already anticipated by Martin, the toy model, the simple model, assumes that there is a single asset-based borrowing constraint of about 2.7 that is calibrated from the Orbis 1997-2007 data on all firms in the EU economy. Which is of course a wider population than the specific innovative firms that we would expect to see as supported by venture capital. Now, this parameter, together of course with the public mandate matrix, primarily determines whether the early stage or later stage targeting maximizes TFP, and as it is also shown by the simulation that Martin showed. The authors themselves note that they are currently running versions where lambda varies with firm age and funding history, which would be more faithful to venture markets. And in fact, empirically, the financial frictions are found to vary across the sectors and technologies as well, in addition to the firm life cycle. And that's perhaps why early stage effects are stronger when financial constraints are more severe. In fact, I would frame this as a competing interpretation of the empirical results from the study of Diff in Diff, where the authors showed that firms receiving early stage financing benefit more from the EIF support. It might be not so much that the EIF should prioritize those early stages because its impact is higher, but rather that the EIF's impact is higher because early stages are predictor of more severe financial constraints. But of course, early stage will not be in that case the only predictor. So in this respect, my first recommendation would be to maybe adopt as a baseline approach a lambda that at least varies by age and history, not only in a sort of an extension of the approach. And if I can kind of elaborate more on this, I would say there is more when applied to innovative firms. The risk of using a one-dimensional asset-based constraint is implicitly compressing a lot of different frictions. They are typically due to different type of information imperfections, but they can be, for instance, asymmetries, moral hazard, managerial capacity, network access, and so on and so forth. While this would be an acceptable simplification, I think it's important to recognize that those frictions can differ strongly by sector. For instance, long cycle, intangible, heavy, deep tech, biotech firms would have a very strong, very different sort of profile in terms of asset-based constraints than the typical sale-based ICT company that, let's say, in 5 years' time has a fully developed product to sell in the market. And in fact, there is a paper, a job market paper by Parry recently released that actually models stage-specific frictions and anticipation, importantly, of follow-on funding risk, and shows that actually late-stage bottlenecks can feed back into the entry, to the early-stage entry of companies. So actually tilting resources to a late stage can actually improve early-stage entry to that extent. This paper does not look at the FP however. So actually this strengthens to my point the case that a baseline with lambda should also vary not only by age and funding history, but also by sector before we can meaningfully draw policy conclusions. And my last point, there is in fact one final corollary. I think lambda here is treated as a constant of nature, but if government, VC, and market reforms can actually expand capital markets and improve the exit conditions, firms' effective borrowing capacity can actually increase or change as a result. In fact, actually, Draghi's report explicitly frames market deepening, like the Capital Markets Union initiative, the improvement of the exit environment for venture capital investments as a competitive lever of its own. And in fact, empirical studies have shown that stronger M&A markets can increase VC deal flow and innovation. So assuming that government spending actually relaxes market friction, stage allocation would need to evolve with market development. I think Martin concluded on that point as well. And in fact, what might be interesting to reflect on, whether my assumption is true, if an investment push might actually lead to non-proportional effects, so it might actually have this sort of knock-on effects, it might actually be more valuable than reallocation, simply because there is sort of this knock-on effect and non-linear effect. So it's not just about doubling that brings double the effect on TP, but actually being more than double the benefit to this deepening of the financial market. That concludes my main observation about the paper. In case I have a little bit more time, I will quickly point on the two other elements. Otherwise, please feel free to stop me. The paper compellingly uses the EF allocation data to calibrate their model. The authors justify this by noting that the EF is de facto the primary public investment vehicle in the European VC. And actually, for this purpose, I put here a chart of VC fundraising in Europe by investor type, with the EAF pink lines explicitly carved out from the other government agencies, a blue line in the chart. So while it's true that the EF captures a significant portion of the public intervention segment, it does not exactly monopolize the public support either, as it stands between 50 and 60% of the public intervention. The rest is, of course, importantly driven by national and regional programs, as already noted by Martin. But interestingly, there is a recent paper by Testa and others in 2024 that notes that national and regional programs tend to actually be skewed towards early stage, smaller ticket initiatives, in a way that makes the EF's intervention much more complementary than representative of the overall public support. So it might be interesting also to consider that angle as well, as it might not just be that the EF is a representative picture there, but rather a complement. I have some ideas about that. I'm happy to discuss them also later if there is time, about why the EF would be complementary / different. But let me conclude on the statement that when it comes to the EF's allocation across investment stages, there is a skew towards a later stage. There was a recent evaluation of the EF's equity and quasi-equity activities that provided numerous breakdowns of the EF portfolio in a time frame that more or less matches the paper's one. The report finds that 67.2% of all equity deals, so the count of specific investments, went to early stage VC deals. So 2/3 of counts went to early stage VC deals, but of course representing only 1/3, 34.3% of total volumes. But actually, this breakdown included also the so-called lower mid-market deals, which in the EF's internal nomenclature, in taxonomy, they follow a different intervention logic than pure VC. So we have VC investments, early stage and later stage, and then we have the growth, private equity, lower mid-market activity. I've referenced the paper for more information about that intervention logic. So I think in line with the author's focus on specifically the venture capital market, it might be convenient or might be at least worth considering removing these investments and only focus on what the EF classifies as early stage VC and growth later stage VC specifically. And if we do that, early stage VC financing represents 80% of the count of the EF supported deals and 52.6% of overall volumes. Now, given the different scales at which the two segments of the market operate, so the early stage versus later stage, with the average investment size in later stage being 3.5 times bigger than in the early stage. I think it's fair to say that the EF activity is at best balanced around the two stages, if not in fact slightly advantaging the early stage investments, but happy to reflect on that. Very last point, and to be fair to the authors, they may not have had access to investment stage splits, because I'm not sure this is disclosed in the EF annual reports. So I think primarily they have used various proxies like firm age, size, we've seen some charts, and also investment size to distinguish between these early stage and late stage investments. And I would like to provide a word of caution here, because unfortunately this may cause measurement error. To be clear, there is high overlap, but probably not perfect. So while PitchBook mentions the 5 years of activity threshold as a guiding principle, it's not a universally accepted rule. InvestEurope, in fact, for reference, does not mention age as a discriminating parameter for the financing stage, but the development of the status of the company in general. And again, bringing this example of biotech and deep tech companies, the 5-year cutoff appears particularly severe, as many 10-year-old biotech and deep tech companies can still be considered early stage in terms of the business maturity. And in fact, the concept of scale-up also varies. There is, of course, a funding round-based criterion, but other studies have used a valuation or funding size-based criterion. And actually, when it comes to data, or at least when it comes to the empirics, the overlap is not extreme, but it is there and is significant. There was one OECD review where about 15% of companies receiving their first VC investments are aged 5 years or higher. And according to a scale-up analysis, 12.5% of scale-up companies were aged 5 years or lower. So there is some sort of overlap there and potentially confusion. Overall, of course, it was, as I mentioned at the beginning, very clear and very well-written paper, very topical, incredibly important right now to steer and drive the, for instance, the investment push, but in general, government policy in this area. It has a strong and well thought out model, which is also providing by and large reasonable and plausible results. And I think the results in particular in the discussion are what makes the paper particularly compelling. As I mentioned, from my perspective, it could be improved by strengthening the model choices around the lambda parameter and include maybe some nuances and caveats when the data and when the sort of the data allows. There are, of course, a few other small drafting quirks that I'm sure will be fixed in a later version of the draft. Thank you for your time.
Thank you very much, Simone. I'm pleased to open the floor for questions. So once again, for those in the room, if you wish to ask a question, please use the microphone. And for virtual participants, you are welcome to ask questions through the Q&A feature in the Zoom application or through the chat. And if you want to speak, raise your hand and the technical team will assist you in enabling the microphone. No, microphone.
Oops. So thanks for the interesting talk. And bear in mind that it's outside my comfort zone, but I was wondering first, maybe you said that, but I lost it, whether like these additional government funds affects, for example, equilibrium interest rates and therefore propensity of entrepreneurs to save or borrow if it works like that. And if you can disentangle this indirect or direct effect from the final results. And second, probably this goes on the same lines as the discussant comments on the lambda. I have a vague memory about endogenizing the constraints of the entrepreneur, like a GT denario or quadrini or something like that. And that might be relevant also in the context of industrial policy. So I think it was something like the entrepreneur has the ability or the possibility to run away with the funds. And this allows you to endogenize, or this was the modeling device, I don't remember, to endogenize these financial constraints so you don't have to rely on the exogenous lambda, I think. And so, yeah, maybe this is a possible solution for what was discussed before. So these were the two questions. Thanks.
Yeah, well, let me first say thank you to Simone for the wonderful discussion. It's always super insightful to hear your thoughts. Thank you. So to answer to this, R is endogenous. The interest is endogenous. This is a GE model. we haven't played with that much to see how much it drives things, but we can definitely do that. Yeah, this endogenization of the constraint, we're working on that. I think it's also going to be interesting though, endogenizing the constraint at the fund level, where in particular, like from the point of view of the LPs and the GPs, whether the GP is going to run away with the LPs' money is going to also be very, very important. And within the part of the mission of the EIF, sort of providing, sort of more certification there to guarantee that maybe LPs are more comfortable. And so we're definitely thinking about that in multiple dimensions. Yeah.
Hey, so I want to challenge a bit this assumption that you make that so the size of the VC market going to late stage is probably 10 times greater than the one going to early stage. And so I'm a bit concerned that, like, I don't believe that if, you just switch off this funding to the late stage and put everything to the early stage, then we'd probably finance 10 times more companies with the same amount of money given the differences. And so I just can't believe that you'd get the same elasticity in terms of employment that you show in the first empirical results, or like these TFP effects, if you were to suddenly fund so many more companies at the early stage. There must be some decreasing returns. You seem to be assuming that you'd see the exact same effect if suddenly you would shift all of this, funding to the early stage. But I think it's not so reasonable. It looks like it's an overestimate, of the inefficiency. Can I ask a second, just a short point? Because also on this side of the inefficiency, there's a lot, and you mentioned it at the end, there's a lot of direct support from government VCs as opposed to via fund of funds. And so like this EIF, it's in your data, I think it's about 1 billion a year or slightly less. It's 5. Okay, it's huge. But all indirect via funds of fund, or it's partly that? It's partly direct, right? It's 2/3 is direct. So basically, I mean, what I'm just trying to understand what is the amount of this inefficiency that we're thinking about, because it looks like a lot of the money is also flowing directly to companies via these, direct investments from government VC, where the problem of this, general scale up is not present. They can do the better targeting or worse perhaps. But so do you have plans to look also into these direct government VC investment? Thank you.
Yeah, I mean, so the first point, and I want to stress this: we don't think that this like naive result. First of all, it's not an assumption; it's a result of the very naive calibration with a very high lambda that you should just bang go all in early stage. We don't think that's realistic at all. Like, we don't think, we just want to say this is a benchmark. Like, if you had a very, very high lambda, if financial markets were relatively developed, in this context, it would make sense to put everything into early stage. We don't think that that's what the AF should do. We don't think that that's the policy prescription. I think we think that the policy prescription should depend on lambda. And for more realistic lambdas, it's probably a lot lower. Even in developed countries, if you make lambda relatively low when the firm is still young and so on, you would still, want to target later stage funding there. On this, whether we want to tackle direct or not, yeah. I mean, like, we're going to go there. I think we went there a little bit in the empirics, and we found that in general, direct investments tended to underperform. In particular, they underperform, but also they seem to be having a lot more trouble scaling up. And so in some way, like actually doing things indirectly through these funds of funds, which the EIF does to a large extent, it's a really good idea, because it's a machine that, again, you're just kind of like scaling up. You don't have to go and relearn, how to pick companies and monitor them, so that might not be your, where your efficiency lays. So, but we might, make it as an extension, especially if we want to account for these rest of the government agencies that Simone was talking about. That are big, that are maybe mostly doing direct. as a way to maybe like broaden the paper quite a lot. I think that's definitely on the to-do list.
Thank you for the presentation. I think it might be a bit related to Antoine's point. First point, I was wondering whether you do or whether you can account for the fact in your model and estimations that investment in younger firms may be riskier than investment in older firms. And still a bit related to this question of risk, can we take away from your presentation that policymakers investing in VC funds are like not taking enough risk, or is it just that their objective is not to like maximize expected TFP, but rather preventing it from falling under a center point? I mean, I guess there might be policy objectives that are related to minimizing risk of TFP in the future.
I mean, like, maybe I should let Simone answer that, but I don't think like, and this might be like the view that is actually held by like the finance academia. They think that they're, too risk averse and so on, and that's why they like are not investing enough in young firms, which, by the way, they're riskier in the model because exit rates are higher for younger firms, right? So that's a problem that makes them more risky, right? I don't think the EIF is like being conservative necessarily. I think they just have different objectives than maybe the market, right? Like they do have returns as an objective to some extent, right? Like it's not like they're still like an investment fund, right? But they also have other objectives, like this policy objectives about increasing productivity, entrepreneurship, and so on. That like make them act in such a way that, for example, like expands capital maybe in sectors where, like, for example, like defense, where traditionally there hasn't been that much venture capital in this need, or say in scale ups where maybe like we're lacking capital there for various reasons, right? So I don't think they're necessarily more conservative or risk averse.
I know that Beryl raised her hand online, and maybe I can ask you a couple of questions from the online Q&A before getting back to the room. So, Beryl?
Thanks very much. That was a fantastic presentation. I really enjoyed Simone's remarks in some of the discussions. So a couple maybe selfishly coming from Canada, I'm trying to leverage this chance to interact. In the Canadian context, where more than over 90% of firms are micro and small enterprises, right? And we see the size systematically scale with firm size. So thinking, sort of drawing parallel from your model, how does the empirical strategy sort of isolate the causal effect of government-backed VC firm outcomes from inherently different, potential growth trajectory, capital intensity, survival rates, right, across small versus larger businesses? In particular, how do you ensure this kind of observed programs and their effect are not essentially numerically and mechanically driven by the deal size heterogeneity and potentially selection into larger and later stage firms?
I can tell you, like, I mean, empirically, like these things, which are the things that everybody does, is through some sort of matching of firms, before the shock, to make sure that, like, you're comparing sort of relatively similar firms, both in terms of their growth trajectories or their size, or even making sure that, like, they're matching on, like, sector and age, of course. And so I think that empirically, that's the way that you do it. In the model, they're definitely going to have different growth trajectories, right? Like, in particular, I was raising about this long run productivity Z, which is going to be Pareto. Obviously, like, if you give money to a firm that has a very high Z, that firm is going to grow a ton more than another that has relatively low Z. Maybe these sort of micro enterprises and so on, right? So that's definitely also, in the model.
Thanks. Maybe just a quick follow-up. Again, and thinking out loud, I think this is very much a comparator or almost the opposite example from the Canadian experience, where we see a lot more early fundraising and sort of challenging in the scaling up funds. Based upon this observation, like we can, you're talking about backwards, moving towards more for lower bound, right? Whereas we're trying to look moving towards the upper bound. What program design do you, based upon your work, that may appear most effective to ensure that kind of policy initiatives or objectives can be met without disproportionately favoring scale ups, right, at expense of the early stage or small firm innovation?
I mean, I think, just if you want to hear my opinion, I think I think like tackling the sort of like pension fund system it would be a big deal. I think a lot of the money that has gone into later stages has been because of the pension funds. I think Canada has actually done very well there. Like, pension funds in Canada are famous for investing a ton of money into venture and so on. The US has done very, very well. I think that piece of the puzzle is missing to some extent. I do think that that's probably what the part of the mission of the EIF is, to sort of bring in those people along that mostly will help a lot in the later stages. Now, I do think that needs to be happening both at the same time as keeping these investments at the early stages, right? So I think in theory you should do both, but I do think that putting the emphasis on this sort of like aggregate constraint of financing that's at the level of the venture capital funds, it's really the important bit. And if you wanted to think about like policy recommendations, some of them could be as simple as maybe lowering capital gains taxes for private investors that invest in later stage funds, or maybe thinking about like the regulating this pension funds but that invest into these asset classes. But I think that requires a bit more investigation before I can tell you precisely what. And part of the agenda that Sara and I have is to go deeper into that and maybe give you a little bit more. But that's definitely a separate paper.
Thanks very much.
Also, Simone has his hand raised. Simone?
Yes, I did promise a couple of more remarks to Martin during my intervention, and also I think I can jump in on the comment that was done on the EF's, let's say, risk sort of appetite. I think when it comes to the bias that the EF might have, I mentioned before, in terms of supporting specific types of fund managers that perhaps might reflect also into the type of companies that we see them invested. This, for instance, average investment size, more or less constantly throughout the size of the company itself, might in part, at least in part, be explained by the fact that the EF supports so-called cross-border investment funds, in that the principle is that they should support more than one country to their portfolio. I don't really have exact numbers in my head, but I think the ratio should be 1/3 to 2/3 non-cross-border and 1/3 at least cross-border. It might be more close to 40-60%. And that certainly affects also the investment size, because from a risk perspective, investing lower than a certain amount at such a large distance, from a moral hazard, due diligence and monitoring perspective, is just not worth the effort. So naturally, then when we have a focus on this type of cross-border initiatives, the average ticket size tends to be sort of higher. And coming back to the point of the risk appetite, there is another element that the EF has stressed a lot in the past years and continues to stress, which is the support of the emerging and first-time investment teams, teams that typically would have themselves difficulty fundraising. So it's like the same concept applied to corporates, applied now to fund managers that actually struggle to receive financing because they don't have a track record in managing a fund themselves, tends to disproportionately support them in the rate of, I think, at least 50, if not even 60% compared to, I think, an average in the market that sits more around the 30 to 40%, at least over a, let's say, relatively large period of time. So these are maybe 2 pointers where we can say, on the one hand, the EF's risk appetite is not explicitly looking at riskier or less risk, in fact, fund managers. And so there is certainly a balance of this aspect vis-a-vis also other performances. I also should mention that a large component of the EF's policy is allocated by using European Union budget money, and that comes with specific policy initiatives. Another pocket of money is coming from the parent company, so the EIB, that has perhaps a little bit more focus also on the return, but typically and historically the return has not been the sole concern of this type of activities. So I think there was an analysis some years ago comparing the EF's return with the market return, and coming actually from the opposite point, premise that this was underperforming portfolio and that should actually not be supported at all. But the actual result was that the performance of the EF portfolio was quite in line with both market standard and market average. So there was not specific, let's say, bias either for or against, let's say, riskier or less risky investments, so to speak. I did want to mention one last point about the anecdotes surrounding the scale-up, let's say, support initiatives. And there's one simple idea that when we see companies in Europe, I think much like also the experience in Canada, has been supporting primarily the early stage segment in the past decade or so, if not 20 years, primarily also because from an indirect intervention perspective, there was really nothing much one could do in some markets where the later stage segment was non-existent. So if you're supposed to do this indirectly and not directly intervening, it becomes very difficult to find counterparts that are reliable and trustworthy to then support that stage. But of course, what we have realized is that we have policy has started to address the funnel at the beginning of the funnel, indeed, at the early stage. But actually, we see that increasingly companies struggle to then get the later on funding. There are two aspects to this. One is that when the company gets larger, of course, it needs larger investments, but it cannot then rely on fund managers or funds that are too small. The typical example being that the average fund size in Europe is 50, 60 million euro. And this means that if you're investing 10, 15 million euro in one company alone, and we're talking scale-ups, this could go very easily up to 100 million euro per single investment, you simply don't have the diversification necessary to actually support that type of investment. And so the idea of having scale-up funding is also the idea of having large fund and large sort of VC funds in Europe. And until basically a few years ago, there were just a handful of billion euro plus sized VC funds in Europe, which indeed automatically meant that the capability to support follow-on funding was restricted. And on top of this, we saw also that when the few large funding rounds would take place, they would have a predominantly, let's say, they would be predominantly composed by foreign investors, primarily the US, for reasons that they simply could afford it at some point. And so, of course, then it comes a question also of the strategic autonomy, which I will not get into, but of course, this has also been the message in the policy circles. I stop with this again.
Thank you very much, Simone. You want to take it, or given the amount of time?
Well, no, yeah, I mean, I've written like 6 pages while Simone was talking. I always do, because you're so insightful. It's incredible. Thank you so much. I think this point that you made about, really the fact that like they put so much money into first-time fund managers. In particular, this year I have 2 MBA students who are, launching a VC fund, and one of the people they're going to ask for money is if they can't go to other, all these types of institutions in their particular country because they just don't give us much money or even money at all to these first-time VC fund managers, right? So the EF's role is to take a lot of risk to put money into these people. So I don't think they're actually very risk averse. If anything, is the complete opposite. Is the complete opposite. Now, I think as Simone mentioned, they do have other constraints on where the budgets come from. They come from the EF, they come from the national governments, and those things tend to be tied to certain things because of changes in the budget. And it could be that the allocation that we see, it's just simply a result of the fact that these budgets are just allocated in the way that they are. It could be that part of it is coming from the sectoral allocation. It could be that part of it is coming from this multi-country, and what we're seeing is sort of like the result of these sort of like policy mandates, which, by the way, are in our model. Like if you go through how the S's are determined and so on, like those mandates, they're there. So we can calibrate them, we can probably change them. So I think that's actually really interesting to think about. But yeah, I think, as now that we're revising the model and thinking about how to enrich it, I think this point, a few of these points that would need to be there. But yeah, thanks so much for all those comments, Simone.
So I will read 2 questions from the online among many that we received. Given the amount of time, apologies for those we won't be able to answer. So we have a first question saying, thank you for your fantastic presentation. If borrowing constraints is the key friction that ends up biasing optimal investment towards late stage startup in Martin's model, it'd be interesting to benchmark the effects of government spending on venture capital against other potential policies that are more specifically targeted towards relaxing those borrowing constraints. Does the crowding of private VC spending make the use of VCs as industrial policy special, or is this just a constrained optimum when we cannot act on other margins? And then I read you immediately a second one, given the amount of time. So in your model, public investment is allocated across specialized funds with fixed mandates targeting specific entrepreneur groups. How does this structure affect opportunity equality in the entrepreneurial ecosystem? Could mandate-based allocation unintentionally exclude innovative but not targeted groups?
So I mean, I think all these things are interesting. There's obviously there's going to be multiple ways in which you could intervene here. You could have use taxes or subsidies to directly affect the constraints, again, both at the firm level, at the entrepreneur level, but also at the fund level. It could be that one of the things that we could do would be lower capital gains taxes on these sort of first time VC fund managers, right? So that when the pension funds come to them, they get a higher share of the pie, right? So maybe that's something that we could do. But I think unless we have a model where we can think about that relative to sort of like the increase in the spending, there's no really clear way for me to tell you this is preferable or not. I suspect that changing taxes that are already in place, or maybe changing some of these mandates that are just given through sort of like the political process might be a lot easier than certain other things. But I think I'm sympathetic to studying them in probably different papers. I think one of the things that I was, and this is kind of interesting relative to the comment that Simone made about returns being sort of very similar to the market. Again, this goes together with the view that we presented, which is there is this machine, there's this technology, which is the venture capital industry, right? And all you're trying to do is just blow up the size of it because we know it's insufficient. And I think that tells you that it's not like we should expect lower returns, or we probably should mimic the returns in the market and just blow up the size. It is true, as Simone was mentioning, that there's just some places where it's not enough, or even at all any kind of later stage capital. Obviously, you need to especially banks are not giving money, sort of try to solve that in some way. Whether you want to do it directly or indirectly, I think we need to go to the model, extend it, and think about that more clearly before we can tell you, how. But I'm just excited for the next year to play around with this to kind of come back with all these answers, but just follow along.
Okay, it's time to close. Thank you very, very much, Martin, for this great presentation. I take also the opportunity to thank Beryl for her welcome remarks and joining us quite early from Canada, and Simone for his remarks. Also, thank you to all the participants, both here in the room and online. We had 80 people. So let me wish you a pleasant afternoon. And the next PI seminar is going to be the 3rd of February with Francesco Venturini from University of Urbino. Thank you very much all.